Hello, investor. Welcome to episode 2 of the Investment Portfolio Challenge. This is the 2020 Quarter 1 review. As always, I'll start with an overview of the challenge. The purpose of this challenge is to start with an investment account of $100,000 and generate growth and income using a variety of investment strategies involving equities, options, and foreign exchange. I'm going to do something a little bit different in this episode, and I'm actually going to screencast my broker platform live with overlays for any graphics and charts. This way you can see all my active positions and I can talk about any specific investments in detail. So what you're currently looking at here is my broker platform. I use Tastyworks, which is a more option-centric broker, and their platform offers a lot of really cool tools to make options trading easier. What you're seeing here is my current profit year to date. I'm recording this video in early April, so the numbers used in the quarter 1 review graphics are going to be slightly different. So to start, let's take a look at the overall performance in quarter 1 and how it compares to the S&P 500, which is my benchmark. In the first quarter of 2020, the portfolio returned $15,315.53 before fees. So we're up 15.31%, while the S&P 500 is down 20% in that same period. We established 49 new equity positions. We used $75,351.35 in capital. That's gone up by about $20,000 since the quarter ended. And we took on 42 new equity positions. That options number is definitely a bit higher than average, but volatility is really high, so we're able to capitalize on profits a little bit more quickly than an average. Towards the end of the video, I'll show you what I look at to gauge volatility and my thoughts on the market moving forward. So let's take a look at some of my positions on the Tastyworks platform. Right now I'm taking a look at my positions. I'm actually going to filter out the options positions. I'll go over them later on in the video. Just want to take a look at my equity portfolio at the moment. So my equity portfolio consists of 53 different companies. It's about $95,000 in capital deployed, and it generates a little bit over 6% in dividend yield, which means I'm generating about $6,000 in dividend payments throughout the year. A lot of that is kind of difficult to project right now because the market is down so much and dividend yields are skewed based on the stock prices. So that's not really accurate, but projections say about $5,000 to $6,000 over the year. I'll scroll down a little bit so you can see all my positions here. It's a mixture of mostly dividend companies, a couple growth companies like Tesla, as you can see near the bottom, but primarily about 50 of the companies are dividend paying companies. I'm actually going to be doing some rebalancing, so it's going to be pared down to maybe about 40 different companies. I'm going to be letting go of some of the companies here that have some exposed balance sheets based on the market crash. Going to be rebalancing, doing some tax loss harvesting, and there's going to be a video released about that shortly, but hopefully save about $4,000 to $5,000 in taxes this quarter because our cash balance has gone up significantly. The equity portfolio is down almost $7,000, but as you can see from my profit loss, we're up at this point $13,000, a little bit above $13,000. So in this next graphic, I'm going to show you why my equity portfolio is down $7,000, but my total profit loss is up $13,000. The equity portion of my portfolio is down $6,885.04. I'm not too worried about this loss at the moment because it's actually unrealized losses, and the majority of the market is doing really poorly. Most of these positions were taken on to bring on dividend cash flow, and so the market fluctuations that are going on right now are not too concerning. I actually think that in the latter half of the year, we'll see a lot of improvement on this side, but again, none of this is realized, so that's okay. And I will be taking on some realized losses, but I'm going to be doing that specifically to save money on taxes, because the other side of my portfolio is doing really well. The options side returned $23,759.75. So that's a little bit under 24% on the year for my entire portfolio. We had a protective put on E-mini S&P futures that performed really well during the initial crash, and some iron condors that were profitable during the first month of 2020. We also had some big losses like the SPX iron condor, but a lot of those losses were hedged using futures, so overall $24,000 in cash, and that's realized cash for the first quarter, is pretty great. So this is actually my favorite graphic. It's all regarding cash flow. This is actually the main purpose of the portfolio, which is to generate income. So we already talked about the 24,000 option premium collected, but actually what I think is more important is the $362.92 in dividend payments that we collected. Obviously that's a significantly lower number than the option premium, but it is in theory more consistent. And so as the equity portion of the portfolio grows, that dividend payment number is actually going to grow as well. And it's a very consistent, or it should be, a relatively consistent monthly and quarterly payment. The great thing about both these sources of cash flow is that they're tax advantaged, meaning that on average, I pay only about 15% tax on my dividend income. And because the majority of the option premium comes from index options or futures options, it takes advantage of a rule called the 60-40 rule, which basically means that 60% of my income is taxed as long-term capital gains, which is 15%, and 40% of those returns are taxed as short-term capital gains, which is my income tax bracket number, which right now is 35%. It's going to be different for everyone, but for me, it's 35%. I also have to pay taxes because I live in California, and that's pretty high. That's going to be about 13%. But the long-term capital gains, which is 15%, is still pretty nice. So if you work out the numbers, you save about, on the taxes that you would pay, you save about 45%-ish on those taxes. So if you take a look at my realized gains of $24,000, I would normally have to pay about $8,000 in taxes, but because these payments are tax advantaged, I end up paying about $4,000 in taxes on the quarter. And I'm actually going to save more money based on doing some tax loss harvesting, which I'll be showing you in a later video. So what are my thoughts on the market moving forward? Since I was recording this, the futures market actually reopened, so we can probably take a look at some of my options positions here. Let me filter out my equities. So I currently have 2 options positions open, or realistically probably 4 different options positions combined into 2 different ticker symbols. The first is in E-mini S&P futures. This is primarily a short position. The market moved up really sharply today, about 7%, 7.03% in the S&P 500. So this short position lost a lot of money today. If you take a look at my profit since open, in the E-mini S&Ps, down 3,700 and since open, and that's changing pretty rapidly here. And in the S&P 500, currently down a little over $4,000. And I'll detail what's going on in these positions. So the first portion of the E-mini S&Ps is actually a debit spread. These first 2 options positions make up a debit spread. I basically collectively paid about $900 to take a $1,600 profit, a range of about $0 to $1,600 if the S&P 500 E-mini futures ends up below 2450 on April 17th. This probably won't be profitable at the end of the option cycle, but it's actually a hedge against my long portfolio, so I'm okay with that. I'm hedging against my entire portfolio. One of my philosophies in this in investing in general is that no single position is as important as the portfolio as a whole. So if I lose $800 on this position, I'm okay with that because it's just hedging the long portion or the bullish portion of my portfolio. The second part is these 2 legs here. There are 3 contracts on each leg, 6 contracts in total, and it's a short credit spread at 2,700 and 2,800 as their strike prices. Essentially what that means is I'll collect $3,900 if the E-mini S&Ps expire or end up below 2,700 on May 15th. Right now the E-mini S&Ps are trading at 2645, so it's a little bit dicey. We have 39 days to go. It's likely that that strike price will be breached, but again, this entire E-mini S&P portion is actually a hedge against my long portfolio, or the long equity slice of my portfolio. So I'm okay taking up to $5,000, $6,000 loss on this portion because it's going to be a relatively small portion of my total gains in the entire portfolio. Again, no single position matters relative to the entire portfolio. That being said, I think there's a lot of downward pressure in the market. Today, the market gained 7% on optimism in the current environment. But that optimism, and I'll show you why I think about this, or why I think this, but that optimism is good for the markets, but there's also a lot of uncertainty in the markets, and I'll show you why I think that. So first though, I'll cover my S&P Iron Condor and credit spread position. So there's a lot of big numbers here, but really it comes down to about $4,000 loss currently. So the first portion of this is an Iron Condor, and I'll highlight the position here. So this was the original position. The strike prices of 2,000 or 2,000 and 1950 and 2,800 and 2,900. That is, the Iron Condor is basically a position that is stating right now that as long as the S&P 500 stays between 2,000 and 2,800 on expiration at May 15th, I'll collect the full credit that I sold this position for, which was about $5,450. Originally, the position were at the profit strike prices of 2,000 and 3,000, and the 3,000 and 3,050 credit portion of the Iron Condor was pretty much fully in profit. So I bought it back and I sold a new position at 2,800. And that's what's creating the big loss at this point. I'm losing about $6,000 on that side of the Iron Condor. But the other side, the put side of the Iron Condor, is making a significant amount of money. So the loss is kind of evened out. And I actually entered a new credit spread, a put credit spread here at 2,200 and 2,100. With the recent optimism, I added to the bullish portion of my SPX options. So if this portion, basically if the S&P 500 ends up above 2,200 on May 15th, I'll be collecting about $2,700. So I can kind of optimize my credit on both sides of the market. I think there's going to be a lot of downward pressure at around 2,700 to 2,800 in the S&P 500. And I'll show you why here. I'm going to open up the VIX chart. And these are kind of going to be my thoughts on the market moving forward a little bit. The VIX is basically a measure of uncertainty and fear in the market. I think that's an oversimplified way to think about it, but this is essentially measuring that in an index. And you can see here we're in a relative time of ease. The VIX at around 14 to 17. This was when we were hitting record highs on the S&P 500. And you see right around March, late February and March, it started to spike up. These levels are 2008 financial crisis levels. And right now, the VIX is right around 45. That's still pretty elevated. And one of my favorite philosophies on the market is volatility begets volatility. That essentially means that when volatility is this high, that means that people are uncertain. and the S&P 500 is up 7%, but the VIX is at 45. So a lot of people are entering the market, but there's still way more uncertainty than what the market is saying. And that's not really good for future projections. Nobody knows what earnings are going to be like. Nobody knows when this lockdown is going to end. And that usually means that these types of big rallies are backed by uncertainty. So I'm not saying that it's a bad time to buy stocks. I actually put an additional $45,000 into the market over the past 3 weeks. So I think it's a good time to buy stocks because stocks are so low, but you should be very cautious about how you enter the market, and that's how I'm treating my current positions. So on that note, this is the end of episode 2. I'm going to be releasing the first of my strategy videos sometime in the next day or two. I'm going to be covering dividend growth investing and how I get a paycheck from 50 different companies throughout the year. Make sure to like and subscribe for updates, and I'll see you next time.